It's Saturday night. Traditional markets are locked, and your charts are completely flat. For a lot of retail traders, this is forced downtime, but a growing number of traders are sidestepping the weekend closure entirely. They're trading synthetic indices, assets that pulse 24 hours a day, 7 days a week. If you spend time in trading communities, you've seen the debate. One side views these as a pure technical environment, while the other dismisses them as algorithmic simulations that lack real economic value. Finding consistency depends on whether your analytical approach matches the mechanics of the market you're trading. If there's a mismatch between your strategy and the market's architecture, you're fighting an uphill battle. Your choice comes down to a specific trade-off. Do you want to trade fundamental reality or algorithmic purity? Forex ties you to global commerce. You're trading human decisions and economic shifts, but you pay for that with strict market hours and the constant presence of unpredictable news. Synthetic indices offer price movements governed by mathematical rules rather than news headlines, giving you full control over your trading schedule. Let's strip away the marketing noise and look at the cold mechanics. We need to evaluate what actually drives price in both systems, so you can stop fighting your environment and deploy your edge where it belongs. To understand these markets, you have to look at the engine under the hood. Forex is the interbank market. Every tick of the Euro-USD is driven by human decisions, trade balances, and economic reality. The true market makers here are massive institutions and central banks. When a central bank shifts interest rates, a currency pair moves. You are participating in a global economic event. Synthetic indices have absolutely zero connection to that real-world economy. The price on your screen is generated entirely by math. Specifically, the engine is a cryptographically secure pseudo-random number generator. It outputs continuous streams of data that form a simulated market wave. These audited algorithms mimic real market behaviors, like ranges, trends, and breakouts, doing so without outside interference from news or bank holidays. Some traders hear algorithm and assume the broker is hunting their specific stop-loss. In reality, regulated providers use these fixed mathematical rules for all participants equally. Think of Forex as an ocean affected by real weather, while synthetics are a high-tech wave pool generated by a machine running continuously. You can apply the exact same moving averages and RSI to both markets, but the way price flows through those indicators behaves very differently. This chart shows the Volatility 75 index. A clear 1-hour uptrend retraces perfectly to a 50% Fibonacci level. Without unexpected economic data, these patterns play out with fewer deviations. The candles follow the technical projection to the target cleanly, without erratic wicks. In Forex, technical analysis only shows you what is happening. Fundamentals dictate why it happens. You might find a perfectly narrowing descending triangle on the UR-USD. It looks like a textbook breakout setup. Look at the bottom right of this split-screen chart. The setup is perfect until the U.S. non-farm payrolls report is released. In seconds, economic reality obliterates the technical pattern, triggering massive slippage that takes out your stop-loss before the market chooses a direction. If you trade the news, synthetics offer nothing for you. But if you are tired of random political tweets or data drops blowing up your technical setups, synthetics remove that variable completely. The math of risk management changes drastically between these two assets. Traditional Forex leverage is often strictly capped by regulators. Synthetic indices frequently offer significantly higher leverage, which multiplies your exposure on every single trade. You also face unique engineered market mechanics, specifically in crash and boom indices. This animation shows a typical crash index. The price creeps steadily upward, but then instantly drops straight down. If you are caught on the wrong side of that programmed spike, it can completely bypass your stop-loss. Then there's the psychological toll. A market that never closes for the weekend or a holiday creates an environment ripe for overtrading. Synthetics protect you from unpredictable geopolitical news, but they replace it with programmed extreme volatility and a severe risk of decision fatigue. Let's map your specific lifestyle and goals to the correct asset structure using this decision tree. If you track inflation, study interest rate cycles, and want to trade the global economy, your path is traditional Forex. If you run expert advisors or strict mechanical systems, you need a predictable, noise-free environment. Your path points to synthetic indices. And if you work a 9-to-5 and can only trade late at night or on weekends, synthetics provide the volume and volatility you miss during the major Forex sessions. If you do transition to synthetics, don't spread yourself thin across 20 different indices. Pick one, like the Volatility 75, and study its specific personality. Consistent profits rarely come from discovering a magic asset. They come from aligning your personal schedule and analytical strengths with a market built to support them. Whichever path you choose, executing your strategy requires institutional-grade infrastructure that can handle the specific demands of your market. That's why FXNX built the NX1 account. Running on MetaTrader 5, it allows you to trade both global Forex pairs and synthetic indices side by side with 0.0 pip spreads. Here is your immediate next step. Audit your trading journal. Look at your last 20 losses. Were they caused by flawed technical analysis, or were you stopped out by news events and bad timing? Identify that leak. Stop forcing your strategy into the wrong market and start trading your true edge.